All right, let's jump right in. Today, we're going to break down Section 85 of the new Income Tax Act, 2025. This is a really powerful tool for saving tax on long-term capital gains. Now, if you're dealing with property transactions, this is one section you absolutely have to get your head around.
Let's start with a really common scenario. Imagine you've sold a piece of land or a building. You've made a nice profit, which is great. But then comes the tax bill, and that can feel pretty hefty. So the big question is, what can you do about it?
Well, the good news is that the law actually provides a specific pathway here. It's a route that lets you reinvest those gains into specific nation-building assets and in the process significantly lower your tax liability.
Okay, so let's get into the specifics. We're talking about Section 85 of the Income Tax Act 2025. This is the provision that holds the key to the capital gains exemption we're discussing.
Now, for all the seasoned professionals watching, this might sound a little familiar. You'd be right. Section 85 is basically the new home for what you used to know as Section 54EC under the old 1961 Act. The section number has changed, sure, but the core concept, that remains the same, which is great for continuity.
So what's the big idea behind this section? Why does it even exist? Well, the government's goal here is pretty clever. They want to channel money from property sales directly into major national infrastructure projects. It's a real win-win, right? You get a tax break, and the country gets much-needed funds for development.
So how do you actually qualify for this tax break? It's not a free-for-all. There are some very specific hoops you need to jump through. Let's break them down into a simple, easy-to-follow checklist.
This table pretty much gives you the entire roadmap at a glance. You've got 5 key conditions, and each one is absolutely critical. Let's go through them one by one so you know exactly what to look out for.
First things first, the type of asset you sold matters a lot. This exemption only kicks in if your profit is a long-term capital gain. And, this is just as important, it has to come from the sale of land, or a building, or both. So if you've made gains on, say, shares or gold, this particular section won't help you.
Okay, this next one is all about timing, and you really can't mess this up. You have a strict 6-month window from the date you transfer the property to make your investment. Miss that deadline by even a day, and the exemption is completely off the table. It's a hard and fast rule.
Now, where can you put this money? You can't just park it anywhere. The law is very specific. You have to invest in what are called long-term specified assets. Think of these as special government-notified infrastructure bonds. The most common ones you'll see are from big players like the National Highways Authority of India and the Rural Electrification Corporation.
And of course, there's a limit. The maximum you can invest under this section to get the tax benefit is 50 lakh rupees in any single financial year. So even if your capital gain is higher, say 70 lakhs or a crore, the exemption is capped at an investment of 50 lakhs.
And finally, this isn't a short-term play. It's a commitment. You have to hold on to these bonds for a minimum of 5 years from the day you get them. If you sell them or cash them out early, well, there are some pretty serious consequences, which we'll get to in just a bit.
Theory is one thing, but let's make this real. Seeing the numbers in a practical example is really the best way to understand just how powerful Section 85 can be.
So let's meet Ms. Singh. She recently sold a property she's held for a long time, and now she's looking at her options. She wants to be smart about her taxes, and she's heard about this provision.
Okay, here are the numbers for her transaction. She sold her land for 1 crore rupees. Now, after we factor in the indexed cost of acquisition, which is just a way of saying we adjust her original cost for inflation, her taxable long-term capital gain comes out to 70 lakh rupees.
So that's 70 lakh figure. That's the amount she'd normally have to pay tax on. And with capital gains tax at around 20%, that's not a small number.
But Ms. Singh is smart. She follows the rules. Within that crucial 6-month window, she invests 50 lakh rupees, the maximum allowed, into those specified Rural Electrification Corporation bonds. She gets it done well before the deadline.
And here's where it all comes together. Look at the difference. Without Section 85, her tax bill would be about 14 lakhs. But by making that 50 lakh investment, her taxable gain plummets to just 20 lakhs. The result, she saves 10 lakh rupees in tax. Just like that. That really shows you the impact of proper tax planning, doesn't it?
Now, claiming the exemption is one thing. Making sure it sticks is another. You have to be really careful with compliance to avoid any trouble down the road. So let's go over the big do's and don'ts.
All right, your compliance checklist. Be absolutely meticulous. Hit that 6-month deadline. Double and triple check that you're buying the right specified bonds. Keep all your paperwork, the bond certificate, proof of payment, in a safe place. And of course, when you file your return, make sure you disclose this exemption correctly.
Okay, now for the traps to avoid. Please pay close attention here. Missing the deadline, we've covered that, it's an absolute no-go. But here's the one that catches a lot of people out. Taking a loan or an advance against these bonds. The tax department treats that exactly the same as selling them. It'll trigger a reversal, and that gain you thought you saved tax on, it suddenly becomes taxable in the year you took the loan, so be incredibly careful with that.
All right, we've covered a lot of ground, so to wrap it all up, let's do a quick-fire review of the key takeaways. Think of this as your go-to checklist for Section 85.
It really boils down to these 4 steps. 1. The trigger. It has to be a long-term capital gain from land or a building. 2. The action. Invest up to 50 lakhs within 6 months. 3. The instrument. The investment must be in those specified government bonds. And 4. The rule. Hold those bonds for 5 years, and whatever you do, don't take a loan against them. You nail these 4 points, and you're golden.
We hope this explainer helps you navigate the new Income Tax Act. Thank you for watching, and for more breakdowns like this, be sure to like, subscribe, and share. And just a quick reminder, this content is for educational purposes only and is not professional advice. Tax laws can change, so always consult with your advisor before taking any action.